All right. Thank you guys for joining Realty One Stop Mastermind. Tonight we are going to be talking with Kurt Weil from Incline Commercial. He is a commercial real estate broker and a real estate investor. So just right off the bat, Kurt, tell me a little bit about what you did prior to real estate and how you first got into real estate as an investor.
I guess I would say I've been in real estate my whole life. My grandpa was a builder on the west side, and kind of his exit strategy, and towards, I would say, probably the last 10 years of building, he was doing four squares and did a rather larger project of like 12 units up in Clifton, kind of on his back end. And my dad was his son-in-law, and my dad was not one of those book guys. He was one of those work with your hands guys. And after he graduated high school, my grandpa told him, hey, go ahead and work for Pepsi, which he's still been there. I think this is his 44th consecutive year. But he said, I'll buy a tile saw. I'm going to teach you how to lay tile. That way, anything ever happens, you can support my daughter. So I would say all the way in high school, I was cleaning apartment units, cutting grass. I mean, my first job was cutting grass at apartment units. Shoveling snow in the wintertime. And then I got into turning units and painting in the summer times during high school and college and doing tile jobs, that kind of thing. And then when I graduated college, my first job out of college was right into learning commercial underwriting. And I kind of lucked into that. Wasn't actually looking directly to go into that, but it worked out. And I was going through all the analysis and everything and going on through these deals. I'm like, man, how are these guys making this kind of money? Dad, why are we getting back then 10, 12 bucks an hour to do this? And it turned into, we went out and bought our first one. That just snowballed, kind of house hack or burr, if you will, on the commercial side, and sized up a few times and acquired more. And it kind of just went off. And then in my professional career, after working for the banks for a few years, I went out on my own, branched out, and became a broker. Like I said, I was always inside. My background is underwriting commercial loans. For my formal credit training, underwriting training comes from, one of the biggest banks out there to working for some of the smallest credit unions out there. And that just morphed into me becoming a broker and saying, okay, well, I know how it works. Let me see if I can go ahead and work with all the banks and everybody I was kind of working with already. And more or less represent the buyer side or my client.
So when you were working in, kind of conventional banking, you were doing writing loans or underwriting loans similar to how you do now, but you're working under, specific banks or credit unions?
Correct. Yeah.
Okay.
So every bank, every credit union, every lending institution has like a business lending policy. And that policy is like, if you ever talk to a bank and they're like, oh, we can only do 75% LTV, or we can only do a 20-year AM, or we can only do a fix for 5 years, something like that. Yeah, that was kind of all that in the underwriting stage. The underwriter's like, hey, this is what we're capped at. This is what we can do. Here's the minimum DSCR. Again, I tell everybody the simplest way to understand commercial underwriting is there's 5 C's of credit. And of those 5 C's, you hit those 5, you're going to make it through. So yes, in my brokerage, I think unlike a lot of other brokers, I still do that today. I still pre-underwrite the file. I take a little bit longer as a broker. I'm like, I'm not going to get you a term sheet in a day. Give me 2 or 3 days, but I'm going to go through it. And if I'm like, hey man, this is a little, your global's a little tight. Is there any other income, or, give me this affiliate return. Maybe there's some add backs on here I can add back that, you're showing a loss, but maybe you cost sagged it and have a huge appreciation number I can add back. And okay, now your global's killing it. Things that I like to vet out ahead of time. That way, by the time it gets to the bank, they already know me, they know my underwriting. They're like, okay, he did this. There's a reason. Let's go ahead and go with it. So it takes a little bit longer on the front end, but expedites the process on the back end.
So with your real estate investing, I know obviously you do a lot of financing, but you've been investing, it sounds like, for how many years now?
But our first property, which was an 8-unit in 2014.
Okay. So going on 10 years, you've been investing, and you're still investing today. I mean, when it makes sense, I suppose.
Yeah, when it makes sense, sure. The last property I bought was in December,
Okay.
and it was a mixed use, industrial flex space with commercial tenants. That was like 6,400 square foot. And then somehow in the same way, the same parcel was 2 4-family properties. So it was kind of like a mixed complex, but it worked out where I teamed up with a buddy from high school who owned an electrical company, and they were looking for space because as they were growing. And the guy that was selling it, his business was folding up shop. I mean, he was just retiring. He's down in Florida now. I helped him do his 1031 and we became friends. He's a really cool guy. But yeah, we ended up buying it, and the best part was it sat on the market overpriced for probably the entire year of 2022 almost. And he had a residential realtor that really just did not do it justice at all. I don't even think he went through the apartment buildings, and that was just detriment on the seller side because we turned the one into a 2-bed 1-bath on the first floor with a walkout, and it had central air and everything. It was the seller's hobby room, so it's like I immediately increased NOI with another $950 a month.
Yeah. So what is your focus as an investor now? I mean, what type of assets are you looking for? Are you just buying in Cincinnati, or what markets are you in? And why are you interested in one asset over another, if you are?
Good question. I'm not necessarily looking. I'm not what I want to say. I'm not hunting for a deal at the moment. And it's not necessarily market based. It's not market driven at all. It's more that, my brokerage business is doing really well. And at almost 100 units, we self-manage everything. And my dad's still working full time. I work full time. My wife is a corporate litigation attorney. She does all of our leasing. And then my mom works full time, cleans well for me, but she cleans hallways, takes back trash cans, but we kind of manage it all together. And we don't really want to take on more. I'm in other partnerships with some investors, some friends, and some other stuff, but the bulk of my portfolio that I own and manage is in Cincinnati, specifically the West Side, because it's what I know. In terms, I would say 90% of that's multifamily. It's what we've always known. It's what we've always done. And if it's not broke, don't fix it. We were always buying at a lower price per door, and it worked. Cash flow was always there. We never really had to lever up greatly to grow. We got very lucky on that front. It started to snowball where, self-managing, we weren't taking money out to live on. That money was sitting in the account. Hey, we got enough. Let's go buy another 4-family. We stayed small and amassed big. So, it was just of that nature. And now, I'm going to be forced to buy something this year with a 1031 that my partners and I, for a property we sold. And, we're exploring other avenues outside of multifamily. Is there something else? Is there something better? Or is there, it's going to be deal based on the numbers, really. But in terms of, am I shying away from anything? No, I mean, the only thing I shy away from is office, just because it's so speculative, which every lender will tell you that. If I was in the space and I knew people that could re-tenant it with or something, yeah, you can make some savvy moves and probably do really great. But where if you could do, the new mini split offices with the shared spaces, sure, it can work. That's just not my thing. That's not my forte. My forte is probably more apartment based, rehab. I mean, I sold the last of my last 3 flips I sold last year. And just, if there's a good industrial spot that like office, or not office, but industrial flex space, that I think I have a savvy move, or, a borrower or a tenant or something that can go in or something, then yeah, it's all about the deal itself and the analytics behind it. So I'm not necessarily opposed to anything. I'm not opposed to going outside of Cincinnati. That's just my preference with me, where I manage and what I do. That's just kind of why I stay there.
Yeah, no, that makes complete sense. And I like the thing you said about you got big by going and staying small. So with that in mind, I mean, what does your portfolio look like? What is the kind of unit range count and property sizes to get you to that 100 unit spot?
I mean, majority of that's going to be four families. We got 15 four families,
Okay.
and some of them we were able to pick up. Like I got 5 that were contiguous, so I was able to pick up 20 units right there.
Oh, gotcha.
And with that, you know, it was a deal that worked out, but at the same time, in majority, and I'm very specialized too. Like I'm majority seniors. I'm 55 and older. You know, there's no hard designation on it. It's just you have to rent it all to seniors 55 and older. And what I love about that is, you know, these are people that have been around the block. They've rented probably their entire life. They've seen good landlords, bad landlords. You know what to expect. They know when to pay. I mean, they know late fees. They know the whole gambit. You know, knock on wood with COVID, it was great because everybody I have is on Social Security, or my commercial tenants are on ACH. You know, everything's coming in. So I didn't really miss a beat on that front. You know, there's no kids, there's no pets, and they use less water. My laundry income kind of sucks, but that's okay. You know, they don't do as much laundry, but they're built-in security systems too. I mean, they'll call me and tell me every time there's a new mailman, like whatever they, you know. So I mean, it's just the model that worked for us. We like it.
No, that's really interesting. And like I like I said, it was an interesting point of your background that you were able to grow to 100 units with mostly smaller properties. And I think a lot of newer investors hear people come on podcasts and they hear people, writing books and on social media where they're talking about trying to scale up and buying, 20, 50, 100 units in their first few deals. And I think it's unrealistic for a lot of people to try to accomplish. So I think that hearing somebody that's really doing it and was able to scale a big portfolio, even by just kind of small deal after small deal that had good numbers, is a different perspective.
I mean, yeah, and I agree with you. I run into the same thing, and I always tell people it's not about unit count. It's never about unit count. It's where do you want to go with this? You know, what's your ultimate goal? And a lot of them, it's that financial freedom. I want to get to X amount of dollars a month. Great. I could probably sell half my portfolio and pay everything off and meet my X dollars per month. My dad's mad at me because we already got it. Oh, I got it. Well, that's enough. That's enough. We don't need any more. I mean, he's going to retire. I get it. He doesn't want to grow. He doesn't want any more. Where I'm kind of like, all right, well, at this point, why do I need to pick up another 20, 40 units? Like I'm happy as two. I'll just focus more on my brokerage business. But with that, it's like, okay, so say you, and I've gone over this with clients too, say you go ahead and buy into a syndication, right? You're going to buy into, call it 150 unit property, whatever it is, use 150 units, right? And, today's market, that's going to call it be 12 million. You're going to put 20% down, so that's 2.4 million, right? If you're going to go and pick up, say, if you're going to put down 10% of that downstroke, right? You're going to put down 240 grand, and you're going to get 10%, right, of that down. So like you're going to get 10%, okay? Of that 10%, you got 10% of 155 units. You got like 15 units. For $240,000, I can go buy four families and get 16 units, and I keep the whole pie. Mm-hmm. So it's kind of always my logic behind it historically is, why am I paying an asset management fee? Why am I paying the acquisition fee? Why am I paying the debt placement fee? I am the debt placement. So it's kind of like never getting into those because, you got that ongoing 1-2% asset management fee and, an exit fee sometimes. It's just however you look at those things. And that's where I'm kind of like, all right, well, I can grow this myself. We can do it ourselves. And then I'm not paying because the GPs decided that we're going to pay management 10%. Yeah, we're going to pay the actual management company 8 and skim 2 off the top, whatever. I don't know. So I would just, I was always, don't get me wrong. I did throw into some syndications with clients that I'm like, hey, you got a good model. I like it. I'm totally for it. I think it's a great way to cost share. On the flip side, you don't have 4 roofs, you don't have 4 sets of windows, you don't have 4 boilers, where you're cost sharing of that 155 with the bigger cash flow number to come out of any type of like CapEx or maintenance and repairs. That is true. Right. So there's the both sides, but in my personal growth stage at that time, I was like, well, we're self-managing. What's up? 4 more units. That's fine. That's not a big deal. So that's kind of where the logic behind that came when I'm looking at, do I buy my property out here on the west side. At that time, it was like, shoot, I can buy something for 150 grand, a four family for 150 grand, 20 down. I'm like, it's 30. So now I'm like, what, 120 for those? Or if I'm putting 25 down, I'm still lower levered and higher unit count. So it
Yeah.
just, to each is their own. It all depends.
No, that makes sense. So switching gears to your broker business. So how did you, or what year did you go out independently, and give me a little bit of backstory on the progression, from then until now, and what is your bread and butter? Like, what do you focus on in your business?
I left the banking world to start brokering in 2016.
Okay.
And then when I went out, I went to a brokerage that was a residential shop and started their commercial division, really. And then in 2020, during COVID, I broke out and just went completely on my own. I'm a one-man shop. It's just me. Last year, I did 196 million in commercial loan production. There was some big loans in there, but my average size went from doing anywhere from 500 to 1.5 million dollar average loan size to now, like, I would say easily 1 to 3 million. So there's still a lot of transactions that happen. Like when we were talking before, I told you my kid, this is a good time for me because my kiddo goes to bed at 8:30, and then this is when I'm underwriting deals. When I have deals in, I'm underwriting at night. And a lot of bankers will be like, oh, I got a deal from Kurt at midnight, or, oh, I got it at 8 a.m. It's like, yeah, you're going to get it either before I go to bed or when I wake up, and kind of blast it out to my network, because that day is set with either meetings and closings or networking or something, right? So, and then the phone calls, you get inundated. But yeah, I started all on my own, I would say, in 2020, and it's gotten better and better. And ironically, I'm still trying to figure out why, but I'm still on pace this year to do as well as last year, if not better. And when I say why, I'm trying to figure that out with the market. Rates have gone up, but I guess what I am seeing, which is a little bit different, is there's different ways of doing deals. People are finding more value add, or they're structuring something with a seller note, or there's something quirky, right? There's some type of twist, or the other shoe, waiting for the other shoe to fall, right? There's always something like that going on now, which maybe brokers become more prevalent because they have those relationships with banks. Like, hey, it's a little different, but will you do this, and explain it kind of in banker terms, if you will.
Yeah. So, you said that kind of 1 to 3 million is your average deal. Like, walk us through that. What does like a typical deal look like that comes to you? And, it sounds like you're doing a lot of volume, so I'm sure there's a wide spectrum there, but, what does a typical deal look like?
Like right now,
Yeah.
not as much refinancing. Refinancing is not really prevalent. Not unless if you were on some type of short-term note over the past couple of years, when you were, buying something and rehabbing and doing the IO and got it stabilized, and, you're delivering to some type of different product, if it's not already built in. But I would say typically it's a purchase scenario. I talk to the client like, hey, I got referred to you, or a repeat client or something, like, hey, I got this deal coming up. Great. Send me the financials, give me the rent roll, the T12. Let's take a look at this. And if it sizes, I do a quick size measure up front. And if it sizes up, then as they go through the process, I collect all their financials, kind of do my underwrite on them globally as much as I did on the property itself, and say, okay, looking at this, if there's a weakness, this goes back kind of that 5 C's of credit, if you really want to get into the analysis.
Yeah. Walk through that briefly.
This is like, everybody talks about the what is it, the wizard behind the curtain. And this is why underwriters never get on the phone with people, because they're very introverted, and they don't want to tell them no. That's what the salespeople are for, right? But it's very simple. It's very simple. It comes down to subject property cash flow. First and foremost, number one, cash flow is king. That's what you always hear. 2, global cash flow. If you have a W-2 and they take into account all your global income and debts, right? So, like when you look at my global, you're looking at the brokerage, you're looking at every entity. Are they all cash flowing? Was he have something that doesn't cash flow? Well, yeah, I have 2 houses from last year that I totally renovated. They're going to show a huge loss. I didn't start renting them until this year. But it's like, that's the things you explain or you back out or, oh, hey, the property took a loss, but I sold it last year too. So you kind of look through that global cash flow and really check that out because you got to tell the story. The numbers don't always tell it. The third thing that you come to is collateral. So when you look at the collateral itself, is it something that bank, like, first of all, is it in their footprint? So every bank has a footprint, right? Like, if you're going to go buy something in Indy, but then you're going to ask, XXX, whatever credit union, they may, well, we only do Hamilton County, Butler County, and Warren County. They may only lend in certain areas. Same with banks. If their branches don't reach certain areas, or a lot of times going back to what I said at the beginning of that, remember the business lending policy, it's the furthest they can go out is like 90, 120 miles of their furthest out branch. So if they got a branch in Indianapolis, they might be able to go up to, Valparaiso. So when you look at the collateral, you're looking at where is it, what condition is it in, kind of that. And then the fourth one is what they call capacity, but it's really coming down to like, what is your capacity? What's the LTV? What is with your cash liquidity? What's the capacity of you being able to take on $1 million loan? Are you there? Can you? Do you have the net worth? Do you have the liquidity? Do you have reserves? Which this is a big hitting point right now in this market. Banks are wanting more and more. Of course, they want the operating checking account. Of course, they want a deposit. That's why they're all super sensitive on trying to get all those items because that's what they're lending towards in the future. But they're building up their reserves as much as they're wanting to take yours. So that's a very big hitting point. I would say probably the most prevalent in today's market. And the last one is what they call character. You can't underwrite character, right? What's the character of the individual? Think he's going to skip out on you? Do you think he's pulling the wool over your eyes? But really, it's more so experience. What's your real estate resume? That's great. You may be a CPA that audits big firms and done it for 20 years, but what do you know about buying, owning, and managing a multifamily unit? You don't. So a lot of times when you have no experience, they require you to put in like some type of professional management up front. Or if you still have like, some duplexes or a fourplex or whatever, they count that as experience. So it goes back to like, how long have you been in real estate? How much have you owned? How do you manage this? So it comes down to experience level. And then, you kind of put that whole story of those 5 things together. Hey, John Smith has got a W-2. He's worked for, Johnson Controls for 15 years and he makes a W-2 of $250,000. He's got the down payment of 25% and global reserves of 12 months. He's bought his first property in 2014 and has been in the game for almost 10 years. This is another purchase for him. This property cash flows on this, and this. I just hit all the 5 C's in one paragraph. So I can summarize it.
And that's actually what you're kind of writing up and submitting to your lenders that you work with. Something like that.
Yeah, I do like a 1-page summary and then like the structure, it's like, who's your borrower? Well, they're going to do an entity transfer and then kind of like go through who's the guarantors, who's signing, what terms we're looking for. But when you do that 1-pager all goes back to what I call the spreads. You have, how everybody, oh, I sent this over to my underwriter. He's going to look at the deal. Oh, I'm going to, my analyst is going to look at the deal. They're spreading the financials on the property and you globally. And they're looking at those 5 C's. They're seeing, when I do that, I have a page that calculates, when I plug everything in, the subject property, the globals, and there's another page doing the liquidity reserves and the down payment. So outside of that, I'm looking at resume bio and I'm coming up with the history on the person and how long they've owned property. And then outside of that, the only thing left is, the property itself, giving a description of what it is, that kind of thing. And then going into what LTV it's going to be at. And that's, yeah, you're putting it all on one page and giving them like a summary saying, here's the deal. And then here's the spreads behind it. And then here's a link to all the supporting financials that came up with all this. There's nothing hidden. The worst thing that can happen is you go to a broker that, and I've had this as an underwriter, I would call them and say, hey man, this doesn't cash flow. What do you mean it doesn't cash flow? I mean, they never even open the tax returns, and you know it because you're on the phone asking them for the password to the tax returns, and they don't even know their password protected. Like, yeah, I know you
Yeah.
didn't look. So you know, it's I think finding a good broker that's going to vet it out front and underwrite it and answer all the questions up front makes a huge difference.
So with that in mind, you know, a lot of people that are in this group and a lot of people who may watch this later are newer investors or people who are, you know, done a couple deals and they're trying to scale up into larger commercial or multifamily deals. So who is your ideal borrower client? And what I mean by that is, um, what can they do to put themselves in the best position when they come to you to get approved for a loan? Let's assume, you know, the deal makes sense. And outside of that, with those things you just explained, what can they specifically do to put themselves in the best position?
Yeah. I'm gonna say this, and don't frown upon me when I say it, because this is the bank mentality of me, right? Or this is the banker side, right? The best loan is to lending to those that don't need a loan. If you got $2 million in your investment account, you're buying $1 million property. Yeah, they're going to give you a loan. I mean, they're looking at that as the lowest risk possible. Cash is king, right?
Okay.
Because you're smart enough to lever your cash to produce a cash on cash return, you know, typically better than the market, right? So that's who they want to lend to. Now, in terms of reality, because we're talking about, you know, probably less than 5% of the business I actually do. I would say right now, with the market and the way banks are, the biggest hotspot is, and this is always the biggest issue, is because this market in the past couple of years has taught everybody about syndicating or you know, oh, double down or grow that unit count. You know, they all focus on that, where you have to, you know, oh, I'm going to get 50 units this year. I'm going to, you know, that mentality doesn't necessarily have to be there. The problem that we run into is limited reserve liquidity or down payment issues, and that's the first thing you got to vet out up front. Banks don't want to hear that, oh, I'm going to pull it off my home equity line of credit, I got the down payment, it's all good. It's like, really? Because you're just going to lever your personal side to build your business side. And like, I get it, as an investor, I've done it before. I get it. You're preaching to the choir here, but I'm telling you, from the banking perspective, they look at borrowed money on borrowed money, because it's not really changing anything, right? It's just now all you're doing is adding an additional payment to your global. Yeah, you can argue that it's going to be paid by the property itself, but to them, it's very black and white, very cut and dry. So that, you know, or like, oh, I'm cashing out my 401k, or, you know, I've had clients do all these things, and I'm not saying it's the wrong move. Some of them headed into a great career in investment real estate. But what I am saying is that it's something to be a little more conscious about, is know where your money's coming from, know that you have the right amount of reserve liquidity. I keep saying that, so I'll kind of explain that. Banks are getting a little cautious, is that they want to see that you at least have like 12 months of P&I, payment reserves, not retirement. You know, it's some type of like a non-retirement investment account or cash money market, something easily converted to cash within, you know, 48 hours essentially. I know a lot of people talk about Bitcoin and stuff. Crypto doesn't count because it's not regulated in the banking industry, so they're not going to count it. If it becomes regulated by FDIC, they probably will count it. But the instability of the regulations behind it and the market that it's in, you got a lot of old school bankers that run banks and they're not sold on it. So it's not something that they're counting yet. But that's probably the first thing that you need to get sorted out, of exactly, you know, where the money's coming from, and have the reserve liquidity. The next thing is, I would say, you know, really know your project. Know your project, and if you're going to do the project, whatever it may be, if it's a full rehab, if it's just a straight purchase of a property, whatever it is, know the market, know your competitors. I mean, it's just like building a business plan for a business. Like, you still have to know oh, the place next door rents 2 bedrooms at this. This is under market at this. I know it can achieve that. But don't just say it. Have the actual data, because it becomes prevalent in many parts of this process. In a lot of realtors, no offense, Joe, but like a lot of the resi guys, I know this is not you, but like realtors, just like brokers get grouped into used car salesmen, right? A lot of realtors, I've had a realtor where he did the biggest deal I think he's ever done, and it was 70 plus units. And his clients were like, hey, can you get us some comps? We want to be prepared when we go to the appraiser. And he gave a comp of a duplex. And I'm like, dude, you're talking 2 different games here. Like, there's no cost sharing. The duplexes don't do a RUBS bill back. Big 70 unit complexes do. Like, it was just night and day difference. And it's like, you can't use that. Like, you got to actually access CoStar and get real data. But that's why I say, like, the like kind properties, same age, same building style. Most of the stuff in Cincinnati you're looking at is low rise garden style, late 50s, early 1960s, build. Make sure it doesn't have things like the stab lock boxes. That's always a big thing. Banks probably don't care as much as insurance companies do, but that aluminum wiring, you're kind of hitting all the marks on knowing what you could raise rents to, what class of tenants you're going to get. That's probably the biggest thing, is just really knowing the inside and out and having the data to back it up. I mean, anybody can sit there and say, yeah, I'm going to rent this 1 bedroom for $925. Okay. How? Are other people doing that? Oh, no, they're not. Okay. Well, then you're probably only going to get $850. And the one thing the bank will never do is they'll never challenge the appraisal. They're never going to challenge the appraiser. The appraiser is going to give market rent on the property. They're going to give their market value of opinion. And a lot of that's based on market rents with market driven data. The market vacancy rate, the market reserve per door. There's a lot of things that go into that. And, they break everything down on a price per door basis. And so that's why I say knowing the market and not overshooting your shot and being disappointed when you come in on the back end that it's not there. You can make a very costly mistake.
And now I assume when you're meeting with clients, so these are the conversations you're having, on those first couple contacts where, let's say I'm putting together a deal that I'm trying to buy. I want to get financing for it. I come to you and I tell you, hey, I think 2 beds in this neighborhood are going to rent for $1,500, but and with all your access to data and your experience that, realistically, they're probably only going to rent for $1,200 or $1,300 a month. Is that something that you're going to be vetting in those first couple conversations before you even attempt to actually present this to the banks?
Yes, I will. And I've lost deals that way. I've lost clients because they thought I was against them. Like, I'm not against you. I'm telling you. And there's times I love to be wrong too. I just had a deal come back where my clients refinanced and they're like, Kurt, what should we expect? What type of cap rate? I'm like, dude, a cap rate right now in this market, like a refinance, this is the first place appraisers are going to. That's where they start increasing the cap rate, right? Which knocks down the value of the property. Because, how can you say that you're getting debt at 6.5% and the cap rate 6.5%? There's no spread for an investor to make money. Excuse me. And so, I'm like, I'd be prepared for an 8 cap. And lo and behold, the appraisal came back great. It came back at a 7 cap. I'm like, good for you. You guys did better. You're going to get a little more money out. I was wrong. I do like to be wrong in those instances, but yeah, I think that, if I know for a fact that I've done other deals in the area and I have market data that doesn't support what they're saying, I mean, I'll say something. Whether they choose to move forward or not, I mean, I've been wrong before. I'll say, well, we can give it a shot. But I'm not there to kill your deal. I'm there to try and make it work. A lot of times I look at deals like, if it's areas that I know, Oakley, Hyde Park, Norwood, anything on the west side, Loveland and Milford, like, I would say those are probably my big areas, where Pleasant Ridge, Kennedy Heights, that's kind of like all that. That's where I'm like, I can tell you probably off the top of my head if I think it's going to work or not. And if I see an issue where I'm like, I don't know, man, are you sure? Like, I'll have conversations with people. And if they're sure and show me the data, I'm like, great, just make sure you provide that to the appraiser. That's who you got to convince.
Right.
So that's kind of where, Yeah, if I agree with that, I don't say anything. I'm like, okay, yeah, I agree with this. Or, if I might make minor adjustments on their pro formas, just because I know that, you know, walking into the the way you're going to run your pro forma should mirror the way that the appraiser is going to have it laid out in his appraisal in terms of gross market rents, average vacancy, yada, yada, yada down the list. And that's kind of what backing in to have those front end calls, that's what's in the back of my mind
And
is
so,
how is that supposed to look?
and so when when you have a client, and I'll use myself as an example, we've obviously worked together. So in my mind, I look at a deal when I'm trying to put together. I look at, I guess I may use different terms than you, but I call it building, a business plan or property plan for that particular deal. What is
Yeah.
it now? What do I see it? What do I see it being in the future? What are the potential options, best use for it? And then similar to what you said, I kind of lay out almost like an outline of what do I want to do with this property? What type of renovations? What level of renovations? Obviously, what I buy, as everyone in this group knows, is typically really heavy rehabs. So that's a big part of what I look at with a plan. And I guess the question I'm getting to is how much of that falls on your client to determine, like as a percentage, how much of that should they already have laid out before they even, sit down with you?
In terms of me and as a broker, I wouldn't say that you have to have anything, but like you got to know I'm going to come asking the questions and I'm going to come asking the hard questions. I've had clients say, "Hey man, this is my first one. Like, can you help me with these comps that you're talking about? Where do I get those? What do I do?" I'm like, "Sure, I'll help you." In your case, like the deal that we worked on, you knew it, and I thought your rental rates were a little high, and then it's like the appraisal. Wasn't that the one where the appraisal came back and the appraiser actually gave you better rents than what you were expecting?
Yeah.
Yeah. So, like I said, I'd like to be wrong.
Yeah.
And you provided the right comps, and that's that's probably more an experience level thing, whereas I work with all kinds of experience levels. So yeah, would I love for you to come and have exactly like what you did and have all those comps and say, I know they can get this, I know this is my worst case scenario, I can get it. I know this property could do this, I know that if I do, this is a C plus, but if I do these renovations it becomes a B plus. I know in this area it's going to rent, I love that stuff, but not everybody there is to that level of sophistication. So I'll kind of work with whoever how I can. If it's a newer investor, I'll rely on the agent. If there's an agent selling the deal to help with the comps and say, "Hey, did you vet this? Like you talked him into getting this thing. Like, how far have you taken this?"
Right.
I'll take over, but give me what you got, not just, "Hey, here's an 8 unit for sale for $1 million. Make this work." Which I've had that happen before.
Yeah. So I guess shifting gears a little bit, and something I wanted to talk and get your feedback and opinions on is obviously we all seen the market shifting pretty, I wouldn't say shifting anymore, but it's kind of stagnated a little bit with the way rates have increased. What are you seeing on your end in the market, and what do you think it looks like, the next 3 to 6 months, or possible outcomes
In
terms of rates, the way they could potentially change, general appetite for lending, commercially, residentially, things like that.
Right now, I'd say it's a pretty mixed bag in terms of rates. You have, the glass half full and the glass half empty mindsets. The half full are saying, "Oh, inflation's going down," or really what it comes down to is the rate that inflation is increasing is going down, and that's the entire piece of what the Fed was trying to hedge.
Mm-hmm.
And since they have that more under control, the idea is that we're not going to have this hyperinflation to devalue the dollar so much, right? And now that we're back into that spot, there's sentiment out there that we should be seeing rate hikes or rate decreases, excuse me, rate cuts over the next, 6 months on the back half of 23. I think that might be a little optimistic. I think if anything, they're just going to hold off because the Fed the only thing they're ever going to shotgun is let's pump rates. We can always just stop. We can always just back down. But that question of should we have increased these probably at the end of 2022? Yeah, they should have. They should have made it more gradual, but they didn't. Again, that goes into a different diatribe of printing way more money than when needed was with COVID. But that, we didn't know. That was the first time we didn't know how much we needed. And that got taken advantage of. And, Oprah gave out free cars to everyone. But now that we're in the situation we're in, I think that personally, I think it's going to stay stagnant. I think that they're going to watch it closely and see, okay, do we have to raise rates anymore? Yes, no, maybe. But they're going to watch that. They're going to watch, the job growth, the unemployment rate. They're going to watch the GDP, the growth rate on that, and they're going to watch, like I said, the amount that inflation is climbing. That it should grow, but at the rate of the growth is what they really measure. There's also sentiments. There's still more rate hikes in the future coming. I can talk to 5 different banks and talk to 5, they all have their forecast from their analyst in New York and all these places, real fancy stuff. It's like, that's great. You got all these economists saying both sides. So, like I said, I'm hoping personally, I just hope it stays flat for a while and then goes down in the future. That's what I think would be best. If it's under control, great. Let us know it's under control and then cut. But just to keep raising, I don't necessarily think that's going to help us in the overall scheme of things. In terms of banks, are they lending, not lending? It has been more picky. Lenders have gotten more picky. Oh, I'm full. I have enough deals right now, or I don't need any more multifamily. They may be targeting particular sectors. What's always going to be hot forever and always, the 2 spots that I think are medical. Anything medical, banks will always do medical. The other thing is the owner-occupied businesses, especially C&I, commercial and industrial, which you're talking a lot more of the bigger manufacturing companies. We're talking full relationship, $100 million deals that have a million different things going on, not just real estate based, excuse me, but like borrowing based line of credits, fleet services, credit card. I mean, the whole gamut. So those are kind of the 2 things that are always going to be hot. But then, nobody's doing office. Everybody's got their fill of hotels. Nobody wants hotels. COVID. I mean, there was already before COVID, what do I want to say? They're called special use facilities, dry cleaners, car washes, gas stations, hotels. There's not much you can convert them to, or the way people say, well, you can convert a hotel to apartments. Yeah, but the way they're built, they're specially built to have not as long as an economic lifespan as an apartment building, which a lot of people don't really understand the difference. The building was built to generate a high amount of revenue with a high amount of foot traffic, with a high amount of in and out use, with a lifespan a little bit lower than what multifamily would be. So, those special uses still, where they may have done it, they're really not doing it. Some people are out of apartment lending. Some people are full. So every bank has their own, look at it as you as an investor, right? You're building your portfolio the same way they have a portfolio of loans. They don't want a concentration in one over the other. So they always try and balance that portfolio. I want, 25% multifamily, 25% industrial flex. I'll reserve 10% for special use. And they kind of try and balance that. So, if their bucket's never full, yeah, they're always lending in it. But again, they're pickier on, right now, I'd say the pickiest I've seen. We've rode a really good market, but it's the pickiest I've seen probably in about 5 or 6 years in terms of asset class. Everybody wants to cherry pick the A+ deals or the super strong deals, but a lot of times they don't want to pick up the lower end deals, and they're saying a hard no now more than, yeah, we'll take a look at it for you type thing.
Yeah, it's interesting. And, I've seen similar things even on the smaller deals, residential side. I think in the 7 years I've been an agent and investor, it's I wouldn't say challenging to find lenders right now, but yeah, like you said, you may not get a yes that you would have got a year ago as easily. And it doesn't seem to, just in general, the sentiment talking to lenders is that it's a little bit more challenging, and you kind of have to find a bank or an institution that wants that product at that time. It's almost like right place, right time with the right deal.
Yeah, I mean, I just had a client call me today and say, "Hey, man, be on the lookout. That deal I told you about in such and such. I went with a different bank than you, but they just told me that they're not interested in anymore." And they dig into it and they look at it and they're like, "Oh yeah, it's like everybody's got that great sales promise up front." It's like, no, I'm going to tell you the truth. I even said, I'm like, dude, this doesn't cash flow. Like this just doesn't cash flow up front. Like you're gonna need, like you may want, if you want to go out for highest leverage and think you're going to get this and that and that and that. No, it's not going to happen. Like this is not the day where that's happening right now, which is a little unfortunate. Where we could have got away with it the past year or two because everything was smoking hot. Rents were going up, values were going up, rates were still a little lower. So it's like, all the sentiment, there was no worry from banks there. Yeah, it'll be all right. And now one little change and it's like, they look back and go, well, this could be 08, 09. We got to look at doom and gloom and prepare for the worst. And that's what they're doing, which is why I think you see a huge amount of pullback.
So my last two questions, then we'll open up to group chat. I don't want to keep you too much longer, but with the some of the bank collapse that we've seen, do you have any sentiment or fear of that being any more of a widespread problem than it already has been? Anything specifically in Cincinnati that you'd be concerned about? Any of our local or regional banks or anything like that, as far as failing with depositors and people like that taking money out of the market?
I think a lot of what happened out west was just piss poor investing from the management side group of those bankers. I mean, they get a bad rap that the one guy, what was it? The one guy was actually at Lehman Brothers, who was a part of in charge of the investing. Mm-hmm. But when that rates are at all-time lows and the only way for them to go is up, why are you investing a ton of the cash that you had, which really was only short-term cash? It wasn't stuff that was going to be sitting on their balance sheet for a long time. So that was like the bigger no-no of just do your 30-day bonds or something. But they were getting into long-term 10-year fixed rates, like in the threes. It's like, dude, you're never going to make money on that. You're actually going to lose money. The simplest way to put it is that for a bank to run efficiently, they need to run at like about 2% of their asset size, right? Like that's essentially their budget if you want to be efficient. You can go down to Federal Home Loan Bank right now. You could borrow a block of call it $100 million, and you're probably going to get about a 4% rate, and it's locked in on a 5-year deal. Okay. That's you borrowing money as the bank from the Fed. You're 2% to run, you're at 6, right? So now you need to make more than 6 to make money. 6.5 is slim right now. You're making 0.5% on 100 million. It's good, but banks are investors too. It's the same way you're buying something on a cap rate and you're borrowing at an interest rate. Banks are borrowing an interest rate. Whatever they're selling you in terms of loan rate, that's their cap rate. They're making the spread the same way you're making the spread. So and that's a lot of things change. There's a lot of variables in that, but that is probably the most simplistic form to explain it. So I think that a lot of those banks that did that, they over levered, they got into bad investments they couldn't get out of, which was just dumb. You don't do that when you know that there's only one way for rates to go up. A lot of banks, a lot of them had a lot of cash that they were sitting on the past couple of years, and a lot of them have been able to lend that out. So now a lot of them are borrowing from the Fed, and now that they're borrowing at an actual rate and not zero, that's why you see rates all over the board. A lot of them want to have, a 250, 300, 350, 400, even up to 500 basis point spread over whatever the 5-year treasury peg is, right? Because typically you're getting a 5-1 arm. And that kind of builds in all the things I talked about. So a lot of times that's how they measure in a typical real estate deal. is they'll go off the 5-year treasury for a 5-year deal and do that spread. So, you know, as long as they're not doing quirky stuff on the backside, you know, they really shouldn't disrupt the process in terms of not being profitable and blow themselves up. In terms of Cincinnati, you know, in the regional market, I really don't think we have any banks that have that issue. I don't think anybody's over levered in that sense. The one spot I would say I know there is an issue, and it's forthcoming, is it's more on the agency. If you're familiar with Freddie Mac, Fannie Mae, how they do larger apartment deals. So I deal in those as well. And there was a particular agency lender who was bending a lot of corners over the past couple of years, that they would do bridge debt up front, right? Because you can't deliver a deal to agency without being completely stabilized and cash flowing. So bridge debt's kind of like your construction note, right? You want money out, you want to redo apartments, you want to get it stabilized to that particular rent roll that the Freddie and Fannie's going to underwrite off of. And they were letting clients get super aggressive on rental rates, on LTVs, stuff like that. And right now, when it's not being achieved, when the rent growth has not increased, but really what has increased for you? Your debt rate. So now they're coming back and saying, hey, Mr. Lender Agency, I'm ready to refinance. My 24 months IO's up. I did everything you said I needed to do, and I did what I said I would do. A lot of those deals don't work. You know, they would do 80% LTV and 100% of cost loans. So, you know, if you bought something for $5 million, you're putting down $1 million, and then you're getting $1 million, 100% financed. So you're still at $5 million is your total leverage, you know, and they're saying, that's great, you know, but with rates went up, we underwrote this with your current rent roll, and we can only get to, you know, 4.5 million. You got to bring another $500,000 to close. Right. And these are like syndicated deals. It's like, that's why you're seeing a lot of prefs being paused, like pref returns. If you see that on syndicated deals, down south, out east, out west, a lot of these higher price things, I would say you're seeing a lot of prefs being paused by syndicators and capital raisers, because they're not quite meeting that, I mean, they don't have the cash flow to hand out. It's being used to pay higher debt yields on the debt that they acquired. So if anything, I see that as being a foregoing issue.
I mean, briefly, do you think that I've heard these rumors in a lot of circles in the real estate world saying that there's going to be this mass foreclosure and all these deals are going to come to market for these short-term debts, and especially in the, like, you know, higher unit counts and syndications and private equity and things like that. I mean, what are your thoughts on that? Do you think that that's true, or
there's some starting to happen? It's a great question, and it really comes down to the lenders themselves, because every lender, every bank has a SAG department, special assets group, you know, REO, you know, real estate owned. They have all these special assets or type of program. Like, it's a group, it's a workout group. They, you know, they fill out what's called like a problem loan asset report because they're missing payments, and then you start getting on their delinquency list, and then it gets transferred from a portfolio loan over to that special assets group, loss mitigation, workout, whatever it may be. And some of those banks, if the loans are big enough and they don't want them to fail, they're like, okay, we're going to extend you 2 years of interest only. You really need to turn this thing around, or you really need to finish all the CapEx and I mean, they got to have some type of workout. Like, it becomes a workout loan. And if the management company or the owners are not savvy with it, yeah, they're going to lose it, especially if the bank doesn't have confidence in them doing it. I mean, the last thing a bank ever wants to do is take a property back. They do not look at that as an asset. They look at that as a liability. Now they're on the hook for taxes, insurance, things that have to get paid. Then they got to pay, you know, a property manager, which is, you know, hired by the bank, and like, they don't want to be a landlord. They want to be a lender. And as fast as they can get off their books, the better better off they are. I think I've done a deal like this previously where I had a guy out of New York bought a property, and he was a numbers guy. I call it a paper investor, someone that was chasing the yield, chasing the cash flow. And he bought this property, and I don't think he really realized, like, you got a management company, but you have to manage them like your employee. Like, you got to check up on them. You actually have to fly to Cincinnati, bud. You got to check out your property. You got to see what they're doing. And I had those conversations with like guys. I mean, I've had someone that's owned nothing and called me and said, I'm going to buy 100 units. I want 100 unit. Okay. Well, what's the average turn in Cincinnati if you're going to put in new cabinets, new countertops, LPV flooring? What's going to be your turn on a 900 square foot 2-bed 1-bath? No idea the cost. So if I'm a property manager, what's stopping me from saying, yeah, I'll do that for you. I'll do it for 10 grand a unit. Only cost me 8 of my subs, but I'm making another 2 on the back end. You never know. And it's like, that's where kind of the experience level comes in. That's why it gets underwritten up front. But I do foresee some of these out-of-state investors, getting caught with their pants down, not checking on their investments, not having the boots on the ground, and not having a tight rein on management when they think management's doing their job. And it's like, dude, when we did this deal, you whittled them down on that management fee from 9% down to 7%. They're not going to put as much work into this as you expect them to when you cut their pay day one.
Yeah.
So I think there's always going to be different expectations. And I think, well, if they're not on top of their assets, they're going to get caught. And, hey, if it's syndicated and it's investor money, you're not really out, they are. So it's easier to walk away from. It sounds good in theory. I've seen a few of it happen. I've seen a few where, I've called bank. I've had a client say, hey, this is like the guy from New York. Hey, I'm putting in like 10 grand a month of my own money. Like, I can't do this. I need to get out of this deal. I need to get out of this deal. And, I think he walked out with like a clean payoff of exactly whatever he owed to the bank. And I went back to the bank and said, hey, we have great owner operators in Cincinnati. If I get them to pick this deal up, will you finance it so this doesn't start hitting your delinquency? Because this guy's out of cash and he's been floating his own cash to make your monthly payment. And they're like, yeah, we don't want that to hit our delinquency. We don't want that to, we don't want to take that back, but give us someone that's very experienced and slide right in and take over. We were able to do deals like that to avoid the situation. And I think that's going to become more prevalent in deals that you're seeing pausing prefs, stop making the improvements because they don't have the money. That's all the things. If you don't put it back in the property, it's not going to, yield you that return that you thought up front. So, those are kind of the beginning warning signs, if you will.
Yeah, that makes sense. So my last question is, with all of this, delay going on with the Congress trying to pass a bill for the increased debt ceiling, do you think if they do not, and I haven't heard any updates today, I haven't checked it, so they could have made progress on that or brought it to vote, but let's just pretend they don't pass a debt ceiling increase. What do you see happening in the banking world if that happens?
That's a good question. I mean, again, it's a mixed bag. Some say we need to, some say we don't need to. If you go back to COVID, what we do? We printed a ton of extra money to hand out. Like, we handed out like candy. And that was all printed money. But when we were keeping interest rates at 0, what was the Fed doing? All these loans that you see that are sold as mortgage-backed securities, like you hear CMBS, commercial mortgage-backed securities, you hear the residential loans that banks all sell to Federal Home Loan Bank, and then they block up. All these are sold on the exchange as a bond fund, right? Even when they say, oh yeah, we'll do medical, we'll do hospital, we'll do schools. That's when you get into municipal bonds, which are non-taxable because of those type of properties, right? I mean, these are all sold, but the Fed was holding all that on their balance sheet. Okay. And when we go to raise rates, what are they doing? Now they're starting to sell that stuff off. So that's how they're retiring debt. They're taking all the money out that they were sitting there holding in dollars and taking it back and essentially burning it, they're taking the dollar back to being actually worth $1 and not printing $1 for every dollar that was already in circulation. Again, if you look at how that works, increasing the debt ceiling is just another way to go against what we've been doing essentially, right? So, are they going to do it? I don't know. I never know what the Fed's going to do. There's so many times I thought they weren't going to increase a half a point, and they did. I thought they would have at least just kept going a quarter steadily and easing into it more, but whatever. So I don't know. That's a great question. I don't really have an answer. If it was my opinion, I would hope that they, if it's a short-term fix in some manner, do it. If not, they would just stop retiring the dollars that they have and recirculate instead of however they do it. They may find a way, but I'm probably not going to have the best answer for that one.
Yeah, I mean, I guess my thought is that I don't so and I don't know all the intricacies of how it works between the Fed printing the money, them basically creating treasury bonds that anyone can buy to create money to then fund the banks and the secondary markets like Freddie and Fannie. And I don't know how that would be impacted, but I guess what I'm more curious about is, are the actual regional banks going to freeze or have some sort of lull and even wanting to lend money with potentially the US defaulting on their the federal debt? That's I guess my bigger concern is, like, is everything just going to come to a halt? Is it going to be like 08 all over again, where they're like, okay, stop,
Yeah.
we're not freezing, we're not writing loans until we see how this plays out in the next 3 months or whatever. I guess
Right.
that's my concern.
Right. Ever since 08, 09, there's been a few measures put into place. For example, you're only allowed to lend a certain amount of your asset size in terms of commercial loans and in terms of home loans, car loans, every different type of loan. There's also, there's a reserve requirement too. For every dollar that you do in a commercial loan, you need to reserve a penny. And all those reserve funds essentially are held like a pool. So if you look at how, the one bank that went bad and it's like, oh, you're not going to lose your deposits, the Fed's going to guarantee that. That's all that pooled reserve money from all these different banks. They're just robbing Peter to pay Paul. Could it become an issue in the future where everybody has to stop lending? Yes, but that would detrimentally crush the banks because lending's how they make their money. I don't think. I mean, we're too big to fail. I don't think we'll default if we do anything. We're so deep in with other countries, specifically China, that we can't fail. We'd have to do another loan regardless. So, I guess in one sense, we're going to raise the debt ceiling no matter what, whether we borrow from somebody else or raise our own.
Yeah.
Something's going to happen.
Yeah, it'll be interesting to see. I mean, supposedly they only have like a week to figure it out. But all right, anyway.
Just remember this. Okay. Just remember this one thing. I love technology, I love social media, I love everything about it. But I will tell you this. When Greece, if you remember, everybody talked about the EU falling because Greece declared bankruptcy, right? And this was this huge thing all over the world. Oh, Greece is going bankrupt. Greece is going bankrupt. Remember this. The Texas, in terms of land and economy size, is bigger than Greece. But they thought that was going to take down the EU.
Yeah.
Right. That's just how much. I mean, there was nothing else going on in the world, so everybody was reporting it. Yeah. So everybody got bent out of shape. It's like, dude, it was smaller than Texas. It wasn't that big of a deal. Yeah. So, I think maybe it might be blown a little bit out of proportion. So many economists have said, even if we don't raise the debt ceiling, we should be fine with, the fact of how we're actually lending money at a rate and bringing money back into the government. They should be able to make payments. It should be not an issue. Yeah. I mean, look at it as this. They sat on a vacant building for the past 5 years, getting nothing on it, and they just re-tenanted the whole damn thing, and now they're cash flowing. Now they can start making the debt payments. So we'll see.
All right, I'm going to open it up to group questions. Anyone, if you have a question, feel free to take yourself off mute. You can type it in chat, or you can raise your hand. We'll try to limit this to 10-15 minutes so we can let Kurt get out of here. Angela, do you have a question?
Yeah, my My cat was just messing with me. I was just gonna make one comment that that bill just passed
Oh,
the
did
House.
okay.
Yeah, so we'll see what the Senate does with it. So, Kurt, anyways, appreciate your insights. Extremely helpful. Um, do you primarily work with commercial real estate, or do you also do residential as well?
I used to do residential. I held my NMLS residential license for a few years, but I was always commercial. I never did enough of it when I went out and started my own company to
Mm,
continue on with it. The annual licensing, bonding, everything to be insured, it didn't make sense for the little amount that I did. So I don't really do it. I specifically focus on 5 unit plus in the multifamily sector, or if you have multiple properties, 4 units or whatever, if it's a blanket or anything on like a contiguous land or same parcel, I will do stuff like that. If you're starting out, sure, we can look at smaller stuff, especially in the residential world. They don't do empty transfers, which is a big thing here in Cincinnati or Ohio that we do, because most states you don't have that loophole. But very, very few and far in between, if you will.
gotcha. Okay. And then as a follow-up, what I was gonna ask you as well, looking at my notes here, um, shoot, I'll come back to it.
Yeah, no worries. If you don't have it now, too, just I'm sure Joe will give you my contact info. Hit me
Yeah.
up.
Yeah, for sure. Oh, I remember what I was gonna ask you. So just to make sure that I fully understand what you do, right? So you are a mortgage broker, right? So if I bring my deal to you and you look at it and then you reach out to some of the lenders that you work with, depending on what type of deal, what they specialize on, and then you would help me secure the funding, right?
Correct.
Gotcha.
Correct.
Just
Yeah.
just 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 making sure.
Yeah, and you may have heard some of the banks, you may not have. Locally here in Cincinnati, I work with over 30 different lenders that I choose to preferably work with. I have a database bigger, but those are the ones that
Hmm.
actually play
Yeah.
ball,
Yeah.
right?
Yeah.
So
Yeah, I
yeah,
mean
no,
that
it's
sounds
just
extremely helpful for sure. I mean, I only have a couple of properties, but what I've done in the past is I try, calling all of these banks and trying to get quotes is not practical. I learned that, pretty quick.
yeah. I mean, a lot of times those guys, if you're just quote shopping, they'll give you the most basic thing of flavor. Right now, they're going to say 7%, 25% down, 5/1 arm at, like I said, 7%, 20-year AM with a prepay of a 3-2-1. And anybody in the world can quote that because that's the average. There's
Right.
anybody that would probably do that deal every day and twice on Sunday right now. So like I say, that 30, it's vetted stuff that I have relationships with the people I either worked with them inside of a bank or brokering with them for years or brought them volume for deals or known them somehow, some way.
Mm-hmm.
To an extent that it makes a difference. But yeah, I mean, you know, you can shop anybody you want. I mean, there's every now and again I've been beat. It's like, okay, well, but then again, they had like some type of relationship or, oh, my dad's got $5 million of that. Well, yeah, you should get a better deal. I don't have $5
Mm-hmm.
million to wave in their face that I'm pulling
Sure.
out of your bank. So yeah, it happens, but the basic phone calls, they're not as cool as they used to, or not as effective as they used to be, I would say, because banks have their fill. They're quoting out the basics.
Thank you.
Randy?
Hey, thanks, Joe. I missed the first probably 10 minutes of this, so I didn't get
That's
your
where we
background
covered.
really.
That's where we covered everything. Everything else was just a load of crap afterwards.
Gotcha.
Yeah, you missed everything.
I've got mostly single families, but scaling into duplexes and 4 units and stuff. And then on the refi, are you seeing? It sounds like maybe you're more commercial, so I don't know if it necessarily pertains, but are you seeing a lot of ARM products right now, or is it traditionally more conventional? Or I mean, I can open it up to the rest of the group too, Joe, if you're
In
doing
terms
ARMs, if
of,
you're staying away from them, or
are you talking about in terms of like a true commercial loan or a blanket loan or like purchasing these type of single duplex investments?
So I've typically purchased stuff with hard money and or my own cash, and then I fix them up and then go back to the bank to get 25-year amortization. But
Yep.
I'm leaning more towards 5 or 10 year ARM as opposed to a conventional fixed rate, just from a cash flow standpoint. But I've been seeing stuff people are saying stay away from the ARMs. So I wasn't sure if that necessarily even pertains to what you're doing or if it's more a group question, but kind of seeing what the products that are
Yeah.
flying off the shelves for you.
So, a couple different things. First of all, like, yeah, I mean, I do blankets of 2s, 4s, and singles. I will tell you the hardest thing to get done right now is a blanket of single family homes. Again, every bank has their fill. Every bank is like, yeah, I got that. I got a guy that's got 50 single family homes. I got a client, I got a great client that's got blah, 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 right? And then they'll say, well, I got a client that's got, 10 homes in Hyde Park that we have a portfolio with. And everything's been the cash out refi. You bird them, you bird 10,
Yep.
great. And that's kind of the thing. And you want cash to go do more. A lot of banks have their fill of that, but again, on a blanket, anything that you're running on the commercial side, you're looking at an ARM. Everything's an ARM. There's no 30-year fixed in commercial. There's nothing like that. There's some special programs, government programs. I mean, typically the longest you're going to find, which is you're not going to find it on those type of deals, but like a 10-year fixed type of product amortized over 25, but you're going to have a balloon either way.
Balloon, yeah.
Yeah, you're going to have a balloon. I mean, there's very few lenders, but some lenders will have the term match the AM, but your rate's still going to change after 5 years. It's still going to be an ARM with an adjustment. And that's when you get into that, like what I was touching on before about the spreads, the 350, the 400 over the 5-year treasury. That's how they're pricing that for future adjustments as well.
Sure.
In terms of purchasing that type of stuff, or even in a refi, I know during COVID, and I'm not as versed on the residential side as I used to be.
Yeah.
But they had, those cash out refis were limited to what, 75? I think they're back up, or 70. I think they're back up to 75 on cash out refis, but you have that 6-month seasoning period. So that's something always to watch out for too, is the seasoning periods if you meet those requirements.
Yep.
Yeah, so I'll say personally, my primary residence, I ended up going with a 5-1 ARM because I was able to get like a 5% rate versus like 6.5 or whatever it was. So I did the math and looked at what's it going to cost me to refi this in the next 5 years, and taking the chance that the rate's going to be lower than or at or below 6%, let's say. And if that's the case, then it'll pay off. And that's just, on a regular 30-year AM, but it's on a 5-1 ARM. And then I think I ended up refining last year one of my rentals. I don't even remember which one it was, but one of them at the time, it was like a 2-point spread between 30-year fixed was, let's say, 7 on an investment property. And I think same thing. I got something like a 5 on a 5-1 ARM. So same, kind of same math. I just took the gamble that in the next 5 years, I'll be able to refi that for lower than 7%. And, my closing cost is going to offset the difference in interest I paid over that term. So,
cool.
That was,
and
I could be wrong, but
the flip side of that though is too, and I'm sure Joe, you probably looked at this, especially like when you get into year 6 on the resi side, that like typically you have like a 2% cap, the most it can increase in year 6. So it's like, if you're getting 5 in year 6, your rate's going to be 7 at max.
And I think it's 1, and I think it's actually 1. Yeah, I think both of those are 1. I know my primary is a 1%.
So if your rates go up, you're still hedging against the risk. If they go down, you're already refinancing anyways.
Right. Yep. So I think Randy, it just you just have to look at what products are out there at the time when you're trying to refi or close a new deal. And, like almost everything in real estate just comes down to the math.
Cool. And I guess other question I had was, from a commercial side of things, do you guys do DSCR loans, or is that kind of a commercial loan itself? Anyway, you're looking at the property, not necessarily the borrower in whole.
Yeah, I mean, I do some. I don't do a lot of it. I actually I got one into myself for a property I have because I didn't realize personally, um, nobody wants Airbnb stuff right now because they look at it as just like the risk of like a hotel, if you will, because it's a short-term rental. It's an overnight rental, daily rate rental, just like a hotel. It's not a true investment. And, I've made the argument personally, well, if it doesn't work, if I don't make more money, I'll just go and rent it traditionally. But it doesn't matter. Banks don't really want that on their books because they have to classify it in that special category. Again, it goes back to that portfolio balance. And I did a DSCR loan on 2 properties I got. And it wasn't bad. I mean, they didn't really look at me personally. They looked at the property. I mean, they pull your credit and make sure you have decent credit. And, they just need a copy of your LLC docs and make sure you can sign everything. But as long as really what that comes down to is they get an appraisal. Again, it comes to the rental rate and they underrate based on that. And if you can meet their DSCR, their cash flow coverage on the property to service the debt you're asking for, yeah, you got it. But then again, double-edged sword, you're paying a higher rate for sure. I would think right now, most DSCR loans are 10% plus. The one that I did, and I use this guy a lot when people ask me for DSCR loans because it was cool. He gave me I did a 40-year term in AM. The initial 10 years was interest only, and it converted over to a 30-year fix. But yeah, so I have a couple, but I don't do it a lot.
Gotcha. Yeah, that sounds like an interesting product.
Yeah.
Yeah, I mean, trust me, I'm in the business. I'll find the weird stuff.
Cool. Any other questions for Kurt?
Yeah, I had a quick question. Kind of going back to you mentioned about entity transfers. So I was just looking it up. It looks like in Cincinnati, they reassess the property taxes every 6 years. So it looks like we're due this year. So like if we were to, do any transfer to keep that current tax rate, would that just go away? I don't know, like, do you have an opinion on that or experience with that? And like, with taxes just go up anyway, regardless.
Oh yeah. Hamilton County specifically reassesses every 3. So our last one was in 2020. You got one now in 23. If it's a true sale and the sale price is reported, I'm going to keep this very vague. Since you can reach out for a phone call if you want for a deeper explanation, but in the vague sense, if the price is reported with Hamilton County, your reassessment's based on the purchase price. If it's not, you're getting the average increased growth that everybody else is as if it didn't happen. So, 2014, the property I had, taxes went down because back then real estate values were going down. So they kind of follow the market. They follow the area, and your assessment's based on that, right? So you'll get that. What is it? The letter from Jill Shishler now. I got like 20 of them that, is telling you, hey, your taxes went up. Your value was this. It's now this, and I'll leave it at yes. I mean, it depends, but it gets reassessed, and if it's reassessed based on nothing showing and just the assessment of what it was, you're going to get that average growth increase. If it's purchase price, you're getting reassessed based on the purchase price.
Got it.
Whether it's
Yeah, and one thing I would add to that is that when you're in a reassessment year, I think it still benefits you to not report a purchase price because then they have to come make an assessment like Kurt just said, and that could be digitally. If it could be like a walk by, I've seen when they do the updating of the photos, the person who comes out to actually inspect properties will give an opinion. So let's say, for example, you were buying a property that needed a ton of work and was really distressed, then it could be a situation where your assessment is actually lower than that sale price. And I think that in any case, especially in a property that needs rehab, I would not want to report a sale price.
I'll add one more thing too. There's Joe, you probably gotten these letters too. They're asking you for additional information of your rent roll and P&Ls and stuff.
Yep.
No thanks.
Yeah.
You may think you have to provide that. No, they're just trying to dig up more information on you that you do not need to supply. I like to keep my financial information personally to myself and protect my own rights. But I've been in courtrooms where the judge, like, fighting reassessments, and the judge has said, "You 100% occupied?" "Yeah." "Case closed. You're reassessed." I mean, they don't care. If you're making money, they want theirs.
Yep.
No, thanks.
Cool. Any other questions? Cool. Kurt, I really appreciate your time. It's almost 10:30 already, so I appreciate you giving us almost an hour and a half. And I think that some of this insight may be a little bit too complicated for the level of some of the people that may watch this. But I think that it's important to understand these things, because as you grow and you get more experience, you start doing more investments, a lot of the things we talked about tonight are going to become very important and very prevalent. I'm trying to put myself, every time I do one of these calls or interview somebody, I try to put myself in the shoes of a new investor. And through that lens, I can look at this and say, like, dude, I'm just trying to find my first duplex. Like, I don't even know what the hell half of this stuff is we're talking about, right? So I'm trying to put myself in those shoes, and I can see where it may be difficult. But again, I think it's these are the things that are important in my world. And I know with some of the other people in this group and where they're at in their investing journey and where they're trying to get to, these are the things that are super important to understand. And like I said in the intro, you're one of the best that I've worked with. We appreciate your time. We do a quick kind of like goal update, so you're welcome to hang out if you'd like to, and if not, I totally understand. I know you got deals done to write, so yeah, thank you again for coming.
It's my next hour and a half. I got a couple deals I gotta get out.
We'll let you get to it then. I really
Thank
appreciate
you
you
all.
coming.
Thanks for your
No,
time.
I appreciate you having me
time.
on.
Yeah,
So
timely,
thank you all. It
absolutely.
was great meeting you guys.
Yep.
Joe's got my info.
Thanks, Kurt.
Yeah. Is there here's what I'll do. I will put your email in the chat so everyone can save it and contact you. And is there any other best way to get in touch with you besides that?
Text, email.
Texting.
If
All
I
right,
don't
I'll
answer the email, I can always answer back on text.
Cool. I'll put the phone and the email in the chat, and I'll put it on. So we upload these into the Facebook group as well, and I'll make sure that all your contacts info's in there for anyone who wants to reach out to you.
Awesome. Thanks again for having me. I
Yeah.
appreciate it.
Thank you.
You guys have a good night.
You too. All right, guys, I know it's late, so we'll try to quickly run through these. If you got to go, I understand. But DJ, you want to start us off with any updates?
Sure. So yeah, we just today signed a term sheet for financing for the Montgomery properties. So hopefully that's going to be rolling along here soon. Hopefully get some momentum on it and start getting stuff done. From a business standpoint, that's kind of where all my cycles have been spent. I've been doing a lot of traveling for the W2 lately, so not a lot of free time. From a personal standpoint, had a great conversation with Gage and Angelo last night at the Best Ever meetup. So I started doing some meditation this morning, so we'll see how that goes. Finished Miracle Morning, started another book, and yeah, just rolling along.
Awesome. Yeah, I'll have to try to get back out to that one. It's been a few months since I've been there.
Yeah.
Awesome. Cool. Angelo?
Yes, sir. So we got the lease for my property in Florence signed. So it is official 100%. They just got to pay first month's rent. here the next few days, and so I gotta get the heck out of here, right? So my rewire is going really, really well. Got 80% of the second floor done. So at this point, I'm gonna finish the rest this weekend and then start moving. So as you guys know, I'm house hacking half that property. The other side is rented out, and my tenant got a great tenant. She pays rent early, so that's also pretty awesome. And then everything else is on track, savings on track right now, and been looking at the MLS a little more often right now. Hoping to maybe get a couple more doors sometime this year. So, but overall, things are going well, and the group's been supporting me, so I really appreciate that. Yes, sir. Thank you, guys.
Awesome. Gage?
Goodness, I couldn't get that thing off. Yeah, all settled in here in good old Riverside. Since I've gotten here, life's been moving fast. Joined a new church out here in Cincy on the personal side. Joined a new church group, which I was at just before this, which is why I was in the Chick-fil-A line when this thing started, and I had my camera turned off the entire time. Let's see what else. Signed up for another race. I got a 4-mile race in Hyde Park, so that's cool. Just really trying to dive into this Cincinnati lifestyle, you know. What else? I put my upper unit up for rent. I've got a lot of contacts through Facebook. One application has been filled out. I just listed it 2 days ago. I'm doing the Joe method and doing all of my bringing everybody in at 1 p.m. on Saturday. So they're all going to come see it on Saturday. And after that, hopefully I'll have my candidate and we'll get that rented out. And then looking forward, as of late, been listening to a lot of podcasts, and a lot of what I've been hearing is just the upside of the off market deals and how there's just so much more room to make money. And that's really where the good deals are found, is off market. Trying to learn more about how to do that. And so if you have any book recommendations or anything, Joe, I reached out to Dylan from the Best Ever, and he gave me some good educational formats like a podcast to listen to and stuff. But I think there's a lot of opportunity in that market. So looking into that as well. So strategies.
Yeah, Dylan would definitely know better than me. I don't think I've actually read any books on off market, direct marketing. Pretty much everything I've done has just been kind of trial and error. And, I think I read some forum posts way back in the day on Bigger Pockets about it. And obviously, I've talked to a lot of wholesalers and gained my insight from networking. But yeah, Dylan's definitely a great resource for that. What was the podcast you recommended?
Oh, it's called, I was listening to it earlier and it was good. I was listening to about Subject 2, Wholesaling Inc.
Wholesaling, cool. I'll have to check that out. Obviously, that's something that, we've talked a lot about this year, and, one of my many interests, so to speak. But yeah, that's cool.
Also, one thing I was in while I was going to the Best Ever, out when I drive around, now that I'm kind of getting familiar with all these areas, I knew that I was in Deer Park, and I was looking around and I saw the property that you bought across from the school.
Oh, yeah. Nice.
And
Yeah,
from
hopefully
off. It was
Yeah.
from very far off, but I was like, I knew it was it because it was right across from the school. I was like, there
Yeah.
it is.
Yeah, there's not many like that either, side by side duplexes. So yeah, they were starting to demo on that this week. So hopefully that's all done. All right, Brian, you got any updates?
Yeah, well, I guess TJ and TJ already kind of gave an update on our Montgomery project, but yeah, I was at that meetup last night too. I met a guy named Brandon, who I know TJ, you knew him, so I got to get to know him, and found out he just started a pickup soccer game every other Saturday. So I said I was gonna join that, so get back into playing soccer, hopefully stay in shape. And I am still doing my run thing, so I did, today's the last day of May, so I got my 10 miles in, so in June I gotta do 12 miles, so keeping up with that.
Nice.
Yeah.
Awesome. John?
Yeah, sorry, this computer has no camera. I'm halfway through the Multifamily Millionaire book by Brandon Turner. Wanted to read that. Spoke about that last time with Gage. Signed up at the jiu-jitsu gym yesterday, trying something new. You know, a lot of new things I'm trying. Interviewed 4 or 5 property management companies in Cincinnati. I know we talked about that, Joe. Narrowed it down, kind of see, you know, who's managing a ton of properties, who's managing a very small, kind of get a feel for what I want, and how personal I want to be, you know, with the property management company. And now looking for off-market deals, just like you guys were just talking about. So I guess we can connect tomorrow or whenever you're free this weekend, and go over that. But ready to pull the trigger on a deal that makes sense. Got the financing in order. So you know, looking forward to it.
Awesome. Cool. Yeah. So quickly with me, I have started working on some of the properties I just purchased, doing clean outs, demos. I'm still waiting on plans for all 3 of them, so can't do too much in the way of actually putting them back together, but trying to get everything demoed and cleaned out so it's ready to go as soon as I have permits. I had a lot of vacancies come up this month, just, you know, natural people moving out, leases expiring month to month. I think as of today, we're going to end up with like 4 or 5 vacancies. They weren't necessarily unexpected, but, you know, just a lot all at once. So most of them are recently renovated, so it should be just, you know, if anything, clean up and place a tenant. Hopefully we'll fill them quickly. I know one of them for sure is going to need a renovation, so that one will take a little bit of time. And we're still progressing on the 28 unit and doing renovations there. So, you know, kind of sucks when they come in waves like that, but, you know, like everything else in real estate, it's always like that. It's always ebb and flow, roller coaster, you know, peaks and valleys. And some months you'll have 10 vacancies and then you'll go 6 months without a single vacancy. So it just nature of the business, I guess. But
I'm gonna throw out a thought that I had about that, Joe, on you know, the rising cycle of tenants leaving as around the summertime and buckling down in the winter. And this might be an unethical question, but would it make sense to do, like, if you're renting them out now, a 6-month lease, and then hit your year lease in December, so it's less likely that they're going to want to, because it's just in your blood. When it's warm in summertime, you want to move around and stuff. When it's wintertime, you want to buckle down. Does it make sense to do that as a strategy, or is that kind of?
I personally wouldn't, and the reason why is because I think that you're right that most people are going to move in the spring and summer. That's probably, you know, 75% of the movement that happens. But I think if people want to move, they're going to move no matter what. And I'd much rather fill a vacancy, you know, in May, June, July versus, you know, trying to fill a vacancy in December. And, you know, it's harder to keep properties clean because you got people tracking snow in and out. People don't want to go look at apartments. Your market of tenants that would be eligible for your property is going to be significantly lower. So I've had to lease properties in December, but what I typically do if that's the case is I make them an 18-month lease. So I'll offer them that and I'll say, hey, look, I'll give you the same price for 18 months. And then that way they go renew on, you know, summertime. But yeah, I think that plan may backfire for you with the logic. But yeah, that's it. I think that's all I got going on. Real estate market's still pretty slow with the way rates are. I think a lot of people are kind of hesitant to sell, and working with a couple potential sellers, but yeah, it's still just kind of a slow grind right now. Awesome, guys. I appreciate you hanging out late. Hopefully you guys learned something from Kurt. I know, like I said, it's kind of higher level concepts and topics. So sometimes it's a little harder to soak up, but it is stuff that's very valuable to learn as you continue scaling as investors. So we will be back on the 14th And as always, if you guys have any questions, comments, or feedback, feel free to connect with me. If you have any specific topics you want to discuss or bring people in to talk about, again, always let me know. I still have a list I'm kind of working off of, but if there's things that you want to see in the near future, please, reach out to me, and I'm happy to arrange that so we can discuss it. And if not,
Just a quick comment before we
Yeah,
go.
sure.
Real estate on tap tomorrow, guys.
That's the one in Kentucky.
No, Madisonville now.
Oh, Matt, it's at Matry.
No, that's where it
Yeah,
used to be.
Element Eatery.
Oh, okay.
Yeah, that's the name of it, right? Element Eatery, right? Yeah.
Gotcha.
So-
I haven't been to that one. Cool. Awesome, guys. All right. I will see you all on the 14th if I don't talk to you sooner, and have a good June.
Awesome. Thanks, Joe.
Yep,
Thank
see you
you.
guys.
Thanks, guys.
Take care.
Yeah.